Now, our next guest is definitely not afraid to speak his mind. I recently had the chance to speak with Peter Schiff, a boom bust favorite and CEO of Euro Pacific Capital. Now, Peter believes that the current housing market is a bubble and says if something doesn't give, the country could be flooded with homes that no one wants to buy. Take a look at what he had to say.
I think this echo bubble that the Fed has reflated in the housing market is already beginning to lose air. And the main difference between this housing bubble and the last one is the last one was more of a Main Street bubble, and this is more of a Wall Street bubble, because the principal speculators are hedge funds and private equity funds and very high net worth individuals who are paying all cash for properties and buying them on the anticipation of selling them at a profit or renting them out to all the Americans who can no longer afford to buy. But I also think this is a bubble. I think a lot of the real estate that was snapped up in foreclosure auctions, I think people overpaid. And I think the investors are just now beginning to realize that they overpaid. So I think the speculative buyers are leaving the market, and there's nobody to fill the void because the real buyers are absent. In fact, if you look at the recent home statistics, the percentage of homes bought by first-time buyers is at a record low. And in fact, home ownership among individuals is at generational lows. So prices have to come down dramatically from here before real buyers can actually afford to buy all the properties that have been bought by speculators. And at some point, the speculators who own these properties, if they can't collect enough rent to cover the cost of ownership, they're going to be selling these properties. And look out below, because when they put these properties up for sale, again, there's no buyers anywhere near the current prices.
So you're saying that speculators overpaid when these homes were in foreclosure? Is that correct?
Yeah, well, initially in the process, they probably got good prices, but then the prices began to run up as the supply of foreclosures was dwindling and more speculators wanted in on the action. They started bidding against each other, and prices were too high. And some people might have looked at prices and compared them to where they were at the peak of the bubble and said, well, I'm getting a 20 or 30% discount, so it's still okay. No, when you're talking about a discount to an inflated price, you can still be paying an inflated price, especially if you look at what the potential is to rent these properties out. Because, you know, the rents are not going to be there. I think a lot of people misjudge the market regarding how much they could actually rent these houses for, because it's very difficult to rent a single-family home. A lot of renters don't want them because there's a lot of other costs associated with it, and I think it's going to cost these hedge funds a lot more money than they think to manage all of these single-family homes. It's going to be very difficult. I think they've bitten off a lot more than they can chew, and you know, a lot of these investors, they paid cash for the properties, but that doesn't mean they're not in debt. They might have borrowed the money through another source. They don't need a mortgage, but they still had borrowed money that they brought to the auction house. So they still have a lot of debt. And if interest rates begin to rise and they have to service this debt, but they're not getting enough revenue from their rental income, they may be forced to put these properties up for sale. But again, if all the speculators want out, who's going to buy? Nobody.
Peter, treasuries have been doing pretty well with the 10-year hovering around 2.50 level. So do you see this low yield lasting? And if not, what impact do you think an uptick in yields would have on the real economy?
Well, first of all, a big uptick in yields would be devastating for the phony economy because it would prick the bubble in stocks and real estate and force a lot of banks to fail, and we'd have a worse financial crisis than 2008. But it would liberate the real economy. I mean, the real economy is being stifled by the low interest rates and what the Fed is doing. So beneath the surface, it would be very positive. It might be painful at first, but ultimately it would be a pain that would be beneficial. Because it would lead to some long-term gain. But I think the main reason that we haven't seen a bigger increase in interest rates since the Fed began tapering is because foreigners have come to the Fed's rescue. If you look at the increase in buying of treasuries from China, from emerging markets in general, from Europe, look at Belgium, for example, you've seen this big increase that has offset the reduction from the Fed, which again they announced today. They tapered back another 10 billion. And if it wasn't for all these foreign central banks, we would have had a more dramatic impact on rates as a result. The question is, how much longer can we count on this support from our friends, especially when we're pissing off so many of them with our foreign policy.
Now, many believe U.S. shares are priced to perfection right now, with the S&P 500 having hit 27 record highs this year. So some American investors are diversifying into cheaper international shares. Do you recommend that move, and why or why not?
Well, I've been recommending that for years, and I've been following that advice personally. Yeah, I think that people should be invested in the stock markets. The question is which markets, which countries, which sectors should they be focusing on, because they're all not the same. So I do believe that there are certain markets that represent a lot of value, where the stock prices are not inflated like they are here, where you get a lot more value for your money. You pay a lower PE, you get a better dividend yield, and you have better prospects. I think here in the United States, you're right, there's a bubble going on. And in fact, beneath the surface, if you look beneath the averages, a lot of stocks so far in 2014 are in bear markets. There are plenty of stocks that are down more than 20% on the year. There are a lot of stocks that are down 10% to 20%. There are some stocks that are making new highs, but it's not that many when you look at the overall market. And a lot of it is based on share buybacks that are financed by cheap money. And it's the low interest rates that make possible the valuations and some of the inflated earnings numbers. So that if interest rates were to go up, that would completely knock the rug out from under these stocks, because not only would it reduce their earnings dramatically, because they would have to pay more interest cost on all the debt that they've accumulated to buy back all these shares, but it would also impact their revenue, because their customers, who also are levered up, they would have to spend more income on interest payments, so they would have less to spend on their products. But now higher interest rates means that you have to discount those future earnings by a bigger number, so the multiples have to contract. So there's a lot of room beneath the market, unless, of course, the Fed comes to the market's rescue with an unprecedented amount of money printing, which I actually believe is what's going to happen.
That was Peter Schiff, CEO of Euro Pacific Capital. Time now for a quick break, but stick around, because when we return, RT producer Bianca Fascini is telling us about staying one step ahead of hackers and how it's a hard thing to do for even the most seasoned cybersecurity expert. And in today's big deal, Redacted Tonight host Lee Camp is sitting down with me to talk about the privatization of prisons and a little bit of Walmart stuff in there as well. Plus, remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrT and on Hulu at hulu.com/boom-bust. Now, before we go, here are a look at some of your closing numbers at the bell. Come on back with us.